Hey YouTube, what's happening? It's Richard, founder of Short-Term Rental University and professional real estate developer. And for those of you that are new to the channel, which is historically all about Airbnb and the short-term rental opportunity set, you might want to know that in a prior life, like 12 years ago, I was a hedge fund manager and I ran a $4 billion with a B dollar portfolio. Well, that was all great into 2007, but about 2008 or so, as the world started to roll over and there was excess leverage and too little fear, in 2008, running a $4 billion portfolio of institutional capital was quite challenging. So in that regard, I've been asked time and time again, what are some stocks that I recommend? This message is mostly for people that are new to equity investing, although even some seasoned pros will like the simplicity of this format. So we're not going to get too fancy. We're going to keep it simple. We're going to make it real actionable. And I'm going to tell you what it is that I'm doing in my own portfolio so that I'm not actually recommending for you to do as much as sharing with you what I'm doing personally. And hopefully that gives you insight, confidence, and it holds your hands to take advantage of what I think is one of the best opportunities I've seen to deploy equity risk capital due to a short-term market dislocation, which will likely at some point in the near future be back to the all-time highs that we were. The economy was strong going into this. I anticipate it will be strong going after this, and this was just a much needed flush out to get some excess leverage, some excess risk, to remind us all to stay humble and to stay grounded and to stay focused and not to get way too far over our skis or to grow too quickly or take undue risk. It's not really necessary. So today's video is not about short-term rentals as much as it is about the rest of your portfolio, which may well be larger in terms of your 401k or your kids' 529 plans. And these are the times that you want to think about rebalancing that. So without further ado, let's get started. So in my personal opinion, one of the best ways that you can learn how to invest intelligently and successfully is you model the masters. Find people that have done this well, read about them, emulate them, study them, and just see if that resonates with you. So for me personally, and for many, the guy who symbolizes like one of the best stock pickers, long-term investors, is Warren Buffett. So read as much as you possibly can about Warren Buffett. I'm a shareholder in Berkshire Hathaway and have been for years. And in fact, I've made the pilgrimage down to Omaha, Nebraska for the annual investor meeting twice, including the 50th year anniversary. And to that end, I want to start with one of his quotes, which I think is really important right now. And that is, be fearful when others are greedy, and be greedy when others are fearful. I made all these videos in 2017, 2018, and 2019, sharing with you all that I was concerned that the stock market had gotten ahead of itself, especially in the first quarter of 2020. I kept sounding the alarm saying this is too far, too fast, it's not sustainable, and it's not repeatable. But I took actions and I documented it on the YouTube channel, so you can go back and check all those out. Understand what happens, when the market rolls over, which it will. The stock market's not going to go up forever. Housing market's not going to go up forever. People spending on travel, there will be periods where that doesn't occur. There's all sorts of things that are influences and affected by the short-term rental market, and those are risks. Some are known, some are unknown, but those risks exist. And I just want to be the guy that's on YouTube and in Instagram and on Facebook and, in emails cautioning people that as lucrative as this is and as great as an opportunity as this is when it's done properly, that there's also risk. If you don't have a large cash reserve and you're using all this money to pay the mortgage, the HOA fees, the utilities, and you're living paycheck to paycheck from your short-term rental business, now is a really good time to start saving aggressively. Put aside like a war chest so that if you have a slow 3 months or 6 month period, you don't default, you're not a forced seller, you've got reserves in the bank, and I would encourage that no matter what. But if this helps you get there and get started sooner because this recession is pending and it's looming over us, then go ahead and do it. But I do know with fairly strong conviction that we are in for a rough ride over the next, cycle, year, 18 months. So what am I doing personally? I'm lightening up. I'm selling this rally. But what's happening right now is there was an excess amount of greed. Everyone was a stock picker. Everyone was a bull market guru. Everyone was having success. And tons of money came into the stock market, and we had one of the greatest rallies we'd ever seen. And although the coronavirus had nothing to do with stock market valuations, The black swan event, the pandemic, it immediately caused a lot of fear. And when there's fear and uncertainty in the stock market, a funny thing happens. All those people that thought they were really good suddenly realize they don't know exactly what it is to do. And all the professional money managers, everyone runs for the door at the same time. And that causes a massive gap down. So if we were trading up here, next stop, boom, straight down. And that's really what happened right now. And what we're seeing is a massive amount of fear. Now, I do want to share with you that the COVID impact is real on the economy. It's real for the people that have loved ones, family members, friends, coworkers suffering through the sickness. And I don't want to make light of that, but this video is really about the economic opportunities. And so I want to focus on that. So when everybody ran for the door at the same time, we basically gapped down and the stock market traded as much as 30% down, basically overnight. And while that causes a lot of fear and a lot of people selling and everyone running for the doors, the worst thing that you can do as an individual investor, especially if you have a long time horizon, is panic. And I've posted in the Facebook group multiple occasions about dollar cost averaging in and how you should be thinking about it. I've also said that if you can't cost average in because you're too fearful, then sit on your hands. You know, when I started working on the Chicago Mercantile Exchange and the Board of Trade back in 1992, I was a clerk and then a trader in the futures and options pit. We wore those funny like colored coats and we were doing put calls and all that stuff. The lesson there was sometimes the best thing you can do is to sit on your hands and do nothing. And that's perfectly reasonable too. So if you can't find the stomach or the wherewithal, or if you don't have the liquidity to make investments today, that's cool. Just don't do anything. But don't sell if you believe that the world will normalize in some period of time, as I very much do. Another thing I want to encourage you to do is to become educated and do so in a playful fashion. And I don't have the book here, I looked for it, but one of my favorite books is called Reminiscences of a Stock Operator. It's written about a stock picker back in the 1900s who made a fortune, lost a fortune, made a fortune, lost a fortune. It reads like a novel in fiction and it's really worthwhile, just a lot of fun. So start taking something that's scary or daunting or that you associate with like pain or fear or insecurity. I don't know what I'm doing. I need to pay professional people a lot of money and I don't know which one to pick. Nonsense. Start to educate yourself, read, make it something that's fun, make it so it's not like daunting, and you start to learn some of the terminology and some of the concepts and some of these like basic investment methodologies that then you can utilize to gain your own wealth, teach your children, teach family and friends and loved ones. It's pretty straightforward. So read Reminiscences of a Stock Operator. And for those of you that are into history and you want to learn a little bit about what's going on right now, very different crises. I'm not suggesting they're related, but if you want to learn about what happens during a crisis, here's a really good book, Too Big to Fail. This is about the 2008 crisis where I was managing, again, that $4 billion portfolio. And ultimately in 2009, when the world really just sort of rolled over and almost ended, I lost my job. I was co-head of investments at a multi-billion-dollar hedge fund, and I was basically dismissed. We couldn't afford my salary, and you know what? I was never really bitter. I completely understood it. If I owned my hedge fund entirely, I would have let the co-heads of investment go too, because sometimes you have to cut off the limb to save the body. Triage, right? So read, study, learn, make it so that something that's really scary just becomes approachable. And over time, it'll become more approachable and then it'll become familiar and then it'll be something that you can do on your own. And the point of this video is really just to help you get started. So to that end, I want to do something called KISS, which is keep it simple, stupid. We do not need to be the smartest guys in the room. Here's a book about when genius failed. This is long-term capital management, one of the most successful hedge funds in the world, until they weren't. Some of the smartest guys in the world, I've met them all individually. I've done due diligence on that hedge fund. My prior boss actually was their boss at Salomon Brothers, where they developed all of those techniques. So we're not going to get super fancy. We're not going to add a lot of leverage. We're not going to do any of those things, but I just want to make a little bit of a joke out of something that most people find intimidating and daunting. So in prior videos, and these date back to maybe 2018 or so, I started to educate everybody about how a return of a stock is analyzed. And there's really two components. There's the alpha component and the beta component. Starting with the beta component, the way you should think about that is that's the return of the stock market as a whole. So if you were just going to go long and you bought the entire stock market, let's say via an index fund, you are basically betting on the beta of the stock market. So if the stock market goes up and you had a 1.0 beta, your return would be the same as the stock market. Alpha is where the stock pickers add value. So they take the beta of the index or the stock market, and then they do some really fancy stock picking. They do some stuff that really adds a lot of leverage and all sorts of things, and they have better analysis. And the value that they add to the beta is considered the alpha. In the world I used to live in the hedge fund world, that was my job. My job was to generate as much alpha as possible. However, where we are today, after a 25–30% decline in the indices due to the corona pandemic, I discourage anybody who is interested in getting started from looking for stock-specific alpha. It's too hard, there's too many variables, you could be wrong, and instead, let's just keep it really easy. And in basketball terms, let's not go for the three-pointer that's really hard and you're way far and you got to make it happen. That's hard. Let's just go for the simple layup, right? Let's just take the beta from the stock market return because we believe that the stock market has been oversold due to an exogenous event that will pass. We don't know if it'll take 30 days, 60 days, 120 days, or 180 days, but I think every single person watching this channel will agree that we will come out of this, just like we did in the Spanish flu of 1918. And in fact, there was a really great quote that I saw on Twitter that I want to share with you all. James Surowiecki, and he wrote, "Everyone predicting that this pandemic will radically change America should at least reckon with what happened in 1957. The so-called Asian flu killed 116,000 Americans and 1 to 2 million people worldwide, and today, literally, almost no one remembers it." And that's a fact. I didn't know that there was an Asian flu of 1957. It certainly hasn't hindered my lifestyle or my approach to travel or anything else. I was caught off guard by this coronavirus as much as the next person. So things will normalize. And if that's our belief, if we believe that things will normalize and we will get back to an ordinary state of business and that a lot of the leverage has been flushed out of the system, a lot of the excess has been flushed out of the system, a lot of people that came to Airbnb because it was a get-rich-quick scheme got flushed out of the system, a lot of people trading stocks on heavy margin and excess margin got flushed out of the system, then not only will we normalize, but I anticipate we'll make new highs because that cleansing is actually super healthy. It's really important that excess gets removed, as painful as it is, and by the way, I've lost a lot of money too. It's still healthy, and that sets us up for a longer term run, right? So the last real financial crisis was 2008. We had a bull market basically for the next 12 years. Now we have another crisis, crash down, and I think it'll set us up for the next 10 or 12 years or further. So with that said, I want to share with you some specific thoughts. We're going for beta. We don't have to be rocket scientists. We don't have to pick the most esoteric up-and-coming stock. And in fact, I'm going to warn you against trying to pick stocks that have done really well in this pandemic. Stocks like Zoom, who's actually founded by one of my friends, or Teladoc, or DocuSign, things that are doing well in the current market environment because they become more pandemic-proof or work from home. Those stocks are already priced in for perfection. So you're a little bit too late to the party. The professional alpha pickers beat you to it. So therefore, I would stay away from it because I would bet more likely than not, everything normalizes and comes back to the mean. So stay away from those. And instead, I'm going to encourage you to sit down with your friends, loved ones, kids, whomever, and just talk about it in these real simple terms. What are some of the best companies that I know and like? What are some of the best brands that I know and like? For those of you that remember Peter Lynch, who was a world famous Fidelity mutual fund manager in the 1980s, this is the Peter Lynch approach. Buy stocks and companies that you know, you like, you frequent, you use their products, and you wish that you could actually own a piece of. And in that regard, I'm going to share with you the stocks that as I've been trimming, and I've been trimming for years, since 2017, I keep selling, The ones that have remained in my portfolio, I'm going to share those with you, and I'm also going to share with you one stock that's not a stock at all, but it's an investment thesis, and I think it really has a great amount of merit. So let's get into it. So the first stock I'm going to recommend, and I really dislike recommending stocks. My entire life, people have always asked me for picks and stocks and so on, and I just think that's the wrong question. So I've always caveated all investment opportunities as such. Here are some stocks that I personally invest in. Here are some stocks that I believe in. Here are some companies that I believe in. And if you find yourself drawn to the same sort of idea, then you too can participate. But I'm not a stock picker, and I certainly don't benefit in any capacity from recommending a stock, and God forbid you were to lose money, that would really crush me. So the stocks that remain in my portfolio today, after all the trimming over the last few years, include Berkshire Hathaway, which is Warren Buffett's stock. And it's really an amazing thing that we can hire Warren Buffett, the stock picker himself, to manage our portfolio and not pay him traditional hedge fund fees, which would be a 2% management fee and 20% or more of the performance fee. We get him basically for free. So if you can hire Warren Buffett to run your money and not pay him an outlandish fortune, then you should. And the best thing about the Warren Buffett portfolio right now, Berkshire Hathaway shares B is what I currently own, because I don't have hundreds of thousands for the Class A share. But the best thing about it is he has an unbelievable war chest of cash. I think it's about $120 billion to put to work. And guess when Warren Buffett goes on a shopping spree? When things are on sale. And guess what Warren Buffett will do on your behalf? He will pick stocks that take advantage of the current environment and the future environment and will return to their highs and then beyond. So the first thing that I can feel really comfortable and confident recommending for almost all investors is an allocation to Warren Buffett's Berkshire Hathaway stocks. I personally invest in the B shares, and I've recommended Warren Buffett for years. And if you are lucky enough to own the stock and can get down to Omaha and check out the annual meeting, that's a really great experience too. You'll meet some great people, and it's just a wonderful thing. So Berkshire Hathaway. My largest holding for years, maybe even for decades, has been Apple. I continue to remain really bullish on Apple. They pay a nice dividend, and while it's a consumer discretionary stock, meaning consumers have to have money to spend $1,100 on an iPhone, and that may not happen for the foreseeable future. There's a lot of people that are suffering and have lost jobs and so on and so forth. I anticipate that given the fact that it's the #1 market cap stock in the world and pays a dividend and has a really large war chest of cash and a huge product and development team, that they will come back. Again, we're not looking for the best performing stock coming out of this. We're just looking for a great stock with reasonable certainty will achieve its past success and then some. And so I feel comfortable with Apple. I also am a big believer in Amazon. I'm a big shareholder, and I think Amazon actually benefits from this sort of pandemic environment, but it's not a pandemic stock like Zoom or Teladoc. It's more a concept of online delivery and logistics and so on, and I think Jeff Bezos is the wealthiest man on the planet for a reason, and so it's not a big stretch. So far, if you think about it, I'm saying pick Warren Buffett, who's one of the best stock pickers in the world, incredibly successful. Pick Apple, incredibly successful company. Pick Amazon, bet with Jeff Bezos. I mean, again, this isn't rocket science, right? We don't need to be super geniuses. We don't need to have a lot of leverage. We don't need to take a lot of excess risk. It's pretty straightforward. And to me, it's somewhat obvious, but I get this question so much, including in our Facebook group, that I wanted to film this video. Another stock that I'm a big fan of, and I actually inherited this from my father, so it's got a little bit of an emotional attachment to me, is Disney. He passed in 2008. Disney stock was trading, I don't know, Charles, pull up a chart. Show 2010 when my dad passed in 2010. I inherited a small amount of Disney. It's not a big holding of mine, but it's got that emotional significance for me. And so I basically bought it or inherited it in 2010 when it was at or near its lows. And then if you take a look at a chart, you can see what it's done in the last 12 years. And now take a look at what's happened in 2020 through this pandemic. As all of the Disney parks are closed and amusement parks are closed, their revenue has obviously taken a big hit. But I anticipate that even with social distancing and us washing our hands more and travel being limited and reduced, there will come a time, a year from now, 5 years from now, 10 years from now, 100 years from now, that people will go to Disney and have a lot of fun and spend a lot of money. And I think Disney also has an incredibly strong and robust opportunity set with all of their digital content and competing with the likes of Hulu and Netflix and so on and so forth. So it's a really great opportunity, both in terms of consumer discretionary spending, going back to the amusement parks and travel and life normalizing, and also a future bet on the digital economy and all of their content, competing with the likes of Netflix and Hulu and so on and so forth. So Disney is a company that we all probably know and like, and it's kind of on sale right now. I feel similarly about Starbucks. I've held a position in Starbucks. I really enjoy the product personally. I love the fact that they're on every single corner. They're incredibly well diversified all over the globe, but when there's a global pandemic, they all shut down. And so if you like the product, or you like the coffee, or you like their business model, here's an opportunity to get into a world-class business at a discounted price, right? Let's put it in other terms. If you walked into Starbucks and you wanted to get your mocha crema frappa latte vanilla, add sprinkles or whatever, and it would be normally like $7, and you got to the checkout counter and they said, it's not $7 today, it's only $4.50. Would you walk out and say oh no, something's wrong, I wouldn't touch it? Or would you say, that sounds great? And maybe would you buy a second one for your partner, your friend, your comrade, whoever, right? So just think of the dislocation in the stock market, and I'm simplifying it obviously, but just think of your favorite stocks or companies or brands being on sale. And when you think about the frappa, mocha, cappuccino, latte, whatever, at $7, and now it's $4.50, you probably like it more. So if you liked the stock before, you should like it more now. Another stock that I personally am drawn to, it's quite controversial, but I think it has a lot of opportunity on the upside, and I'm not here to discuss the merits of it, but I do just want to give you a little sprinkling of something that has a little bit more, oxygen. It's got a little bit more fuel. It could go further, faster. It could also go down, right? That's the thing about risk and reward, and I've made many videos about that, right? If you're going to get more reward, you're taking more risk. So this next one is far more risky. I'm personally drawn to not only the entrepreneur, not only the business, but the multiple business lines, and that's Elon Musk's Tesla. And I know it's a really famous short, and a lot of people really dislike it, and they think it's going to zero. And then I can point to Ron Barron, who's a billionaire founder of Barron Capital, who thinks from here it could 10x or 100x, hasn't sold a single share. Personally, I think the future is electric vehicles and solar energy, and so I take a small position, and that's the way I manage my risk and reward. I don't shy away from a stock and a story that I like, I just control my size. So if you like Tesla and you're putting, say, $1,000 to work in each of the other names that I mentioned, and you think Tesla's worthwhile, but maybe it's risky, maybe put in half. Back in the day, my boss Tom used to call it a half loaf. Just put in a half loaf. You don't need the whole thing, but don't shy away from it either. And then the final selection that I have for you is probably the most controversial, by far the most risky, but also has by far the most upside, and I'm a proponent and an advocate of the blockchain and of Bitcoin in particular. And today, Bitcoin outside of real estate is my single largest holding, and I think it will continue to be, maybe even get bigger as it grows. And one of the reasons, fundamental reasons, that's particularly interesting and appropriate right now is what the Federal Reserve and the US government is doing right now to shore up our economy, which is really important, is the $2 trillion stimulus, and just pumping, injecting helicopter money. We're just flooding all of this money into the system, which is really needed right now, but that has dire consequences in the future. So if you think about it this way, what we've basically done is we've solved a short-term, immediate, really painful problem by kicking the can down the road, and the problem will persist at some point in the future, and it might be like our kids' generation or our grandkids that deal with it, but there is no such thing as a free lunch. You've probably heard that adage. You can't print billions of dollars of money and inject it into an economy without unintended and some known consequences. And Bitcoin, to me, is the exact opposite. There is no central bank, there is no Federal Reserve, there is no injection of liquidity. There's a finite number of Bitcoin, it will never increase. And in fact, the way that the miners algorithm works is there's a tightening. So in fact, as they mine all of these Bitcoins and calculate all the different transactions and process that, they get rewarded in Bitcoin. There's a halvening happening in about a month. We don't know exactly when, it depends on the algorithm. But basically, as opposed to us flooding the system with money, the way Bitcoin works is it becomes even more scarce. They dole out less reward for miners doing their job going forward, so therefore the supply is actually almost cut in half. And that's why it's called a halvening. The mining reward is cut in half, so there's fewer Bitcoins being mined and introduced into the system, and it's a finite number. So the way that I like to invest is to think about scarcity value. Anything that's in demand by many people and there's a finite number, if it continues to be in demand, generally speaking, Econ 101, more demand than there is supply, prices go up. And so it's pretty straightforward. I love the fact that it's independent. There's no central government. It's completely protected and private. There's a lot of benefits. It's transactional. You can do 24/7, 365. You don't have to wait for the bank to be open or the stock market to be open. There's no T+2 settlement dates. There's a lot of reasons why I think blockchain and digital currency are the future, and not the least of which is the fact that it's controlled by math and finite resources, as opposed to Federal Reserve and central bankers and government that can make changes on a moment's notice depending on what comes our way. Bitcoin is something that I think is worth betting on, and the way to bet on it is as follows. I recommend a 1% position. So if you have $100 in stocks, put $99 in stocks and $1 in Bitcoin. And I think the risk reward, the most you can lose is that $1, but that could easily be worth $10 or $100 or more in the future. And so why not take a little bit of a flyer? It makes a lot of sense. And in closing, some of you may not want to pick individual stocks. I totally get that. And I don't usually start with stocks, except that was the question I was asked. I usually recommend people buy indices. And so the way that I would recommend you do that is a low-cost index fund by Vanguard, the Index 500. Large cap US stocks is great. They also have a broader one, the 5,000. It's called the Total if you want that. They also have international ones. So pick your flavor. For me, I've always been a proponent of the Index 500. And there's a stock, an ETF, it's called the SPY, SPY. If you have a trading account and you don't want to open up a mutual fund account, just buy the SPY. If you're more technology focused, go ahead and buy the triple Q. QQQ, it's the NASDAQ 100, and that's got a technology flavor to it. And what does that mean for those of us that have 401ks or 529 plans and we're not picking individual stocks? What can we do about that? Well, I'll share with you what I did personally, and hopefully it helps you understand the opportunity that you may have in front of yourself. So for my children, I've always invested via 529 plans. I love being tax efficient. I love deferring taxes. And the 529 plan allows me to do just that. Invest for them on a tax-deferred basis and have it compound over long periods of time. And so I always max out my kids' 529 plans. And the easiest way for me to do it is to pick an age-based investment thesis, right? So I indicate what year they were born and what year I think they're going to go to college. And then the algorithms just say, well, based on that age, and when you need the money, you're going to have, say, 75% in stocks and 25% in bonds. Right now, my eldest daughter is 18. She starts college next year. So what I've done for her is looked at her portfolio, recognized that as bond yields have gone down and stocks have gone down, the value of her bond prices have gone up. So she's now overweight bonds and underweight stocks. And I've basically rebalanced it by selling bonds and buying stocks. And my bet is stocks will go up from here. And so I'm fortunate that I don't need this income to pay for her tuition next year. And if anything, I'd like to pay less in future years. So I think it's a really good opportunity to rebalance your 401k, your pension fund, your 529 plans. And depending on how many years you have until you use it in your financial position, it might be a really opportunistic trade to sell bonds and buy stocks. I think you'll be rewarded handsomely, and it's not particularly risky. In fact, I can make an argument that it might even be less risk. Speaking of risk, I am not calling a bottom. This is not Richard saying on April 6th, we've bottomed. We had a really strong rally in the market today. I think there's a really good chance that we roll over and we test the lows again. I personally don't think we go through the lows, but we could. And I anticipate that we'll test the lows. So consequently, as I started the video, I'm going to encourage you to dollar cost average. If you have $100 to put to work, say you're going to split it up into 4 tranches, $25 per buy, and then pick your time frame. Do you believe we're going to recover relatively quickly? If so, pick weekly. I buy every Monday for 4 weeks in a row, $25 times 4, that's my $100. If you're more bearish or you think that the coronavirus impact is going to last longer, then pick every 2 weeks or once a month. So if it was once a month, you pick the first Monday of every month and you do that for 4 months. And over the course of 4 months, you become fully invested. But don't try and catch the falling knife. Don't try and catch the bottom. Don't chase the rallies. Just do it methodically. Set it, forget it. Remember where this whole thing started. KISS. Keep it simple, stupid. And the most important thing, if you listened to this video and you went out and you bought stocks or indices or you dollar cost averages, you rebalance, you did anything here, you must not pay attention to the prices. Do not get sick to your stomach and sell. That's the biggest mistake. We're trying to take the easy money out of this. So if you don't enjoy it, it causes anxiety, it causes stress, and that's totally normal. It's kind of like, I was a professional money manager. I'm in my comfort zone during this dislocation. I can look at these prices, but the average person that isn't doing this professionally gets sick to their stomach, get worried. How am I going to pay for college? Oh my gosh, I just lost $100. I can't. And then they exit. In the trading parlance, we used to call it something really graphic. So pardon me, do not puke out your position. You must hold in order to see the gains. So if you can't hold, then just don't do it. Stay where you are. But if this makes some sense to you and you want to get started or you want to add or you want to start to dollar cost average, you want to become more educated, then just remember, you must be fearful when others are greedy and greedy when others are fearful. The stock market down 25, 30% is telling you that other people are fearful. Now is the time that we get greedy and we start to average in. And the most important thing is once we're in, ignore the screens, turn them off, don't look at your statements, know yourself better than you know yourself today, and just ignore it and hold. And the longer you hold, the better you'll be rewarded. And with that, I'm fairly confident. Again, I'm just telling you what it is that what I'm doing. This is not advice. I'm not selling anything here. I'm giving you the most information I have that I think will be most helpful to as many viewers as possible, because I want us all to come out of this stronger, healthier, happier, more knowledgeable, more secure, more confident, and more optimistic that the best is yet to come. So I'd love to hear your comments and thoughts below. Please like the video, comment below, and let's go, friends. The best is yet to come. Thank you.